Marcus and Elena sit at the same kitchen table in Denver. Same street, same jobs, same index funds. Marcus has $190,000 invested. Elena has $240,000. That's it, a $50,000 difference. Last year, Marcus contributes $6,000 to his portfolio. He feels proud, disciplined, in control. Elena contributes the same $6,000, same effort, same habits. But by December, Marcus's portfolio grows by about $15,000 total. Elena's grows by over $25,000. Same funds, same market, same behavior. Yet Elena's money is now making more money than she is adding. Marcus is still pushing the car. Elena's engine has already turned on. And what separates them isn't discipline or intelligence or timing. It's a line most people don't even realize they've crossed. Because somewhere around $200,000, investing stops feeling like work and starts behaving like something else entirely. Hey, I'm Brian, and I spend way too much time thinking about the exact moment money starts working harder than you do. Today, I'm going to break down something financial advisors understand instinctively, but rarely explain clearly: the mechanical shift that happens around $200,000. This isn't motivation, it's math. And if you care about making smarter decisions with your money, think of subscribing as the highest return on attention you'll get this week. The first shift is uncomfortable because it challenges how you think progress works. Most people believe wealth comes from how much you contribute, save more, invest more, repeat. And that's true until it isn't. At $100,000, an 8% return gives you $8,000 in growth. That still feels smaller than your effort if you are contributing $10,000 per year. You are still the engine. But at $200,000, that same 8% return becomes $16,000. Now compare that to a typical annual contribution of $6,000. Your portfolio is now contributing almost 3 times more than you are. That's the flip. According to long-term data from firms like Vanguard, average market returns hover around 7 to 8% annually. That means once you cross this threshold, the math quietly changes roles. Your money becomes the primary worker. Think of it like pushing a massive flywheel. At the beginning, every push matters. It barely moves. You feel every ounce of resistance. But once it reaches a certain speed, it starts turning on its own. Marcus is still pushing. Elena's wheel is already spinning. Take James, a 38-year-old engineer. He spends years contributing aggressively, hitting $180,000. Every gain still feels tied to his effort. The moment he crosses $210,000, something subtle shifts. His annual statements start showing gains larger than his contributions. For the first time, he feels carried. The action here is simple but critical. Stop measuring progress by how much you add. Start measuring progress by how much your money generates without you. Because once your returns exceed your contributions, you are no longer building wealth. You are managing momentum. The second shift hits you in the stomach, not your spreadsheet. At $50,000 invested, a 10% market drop means losing $5,000. It stings, but it feels manageable. At $250,000, that same 10% drop is $25,000. Same percentage, very different emotion. This is where theory collides with reality. Dalbar, a financial research firm, consistently finds that average investors underperform the market by about 3 to 4% per year. Not because they pick bad investments. Because they react. They panic during downturns and hesitate during recoveries. Now imagine watching $25,000 disappear in a few weeks. That is a year's salary for some people. It doesn't feel like market volatility anymore. It feels like loss. Like something is being taken from you. Consider Aisha, a marketing manager who builds her portfolio to $230,000. She knows, intellectually, that markets fluctuate. But during a downturn, she sees her account drop by $22,000. She sells, just to feel safe. 3 months later, the market rebounds. She buys back in higher. That single emotional decision costs her thousands. Volatility at this level is like turbulence on a plane. At low altitude, it's uncomfortable. At high altitude, it feels dangerous, even if the plane is perfectly safe. The shift here is not about avoiding volatility. It's about preparing for how it feels. You need rules before emotions show up. Pre-commit to what you will do during a downturn. Write it down. Decide in advance that a 10% drop is not a signal, it is a normal event. Because once your portfolio crosses $200,000, the biggest risk is no longer the market. It's you. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. The third shift is where small mistakes become expensive ones. At $50,000, being slightly overexposed to one stock or sector might cost you a few $1,000s. Painful, but recoverable. At $220,000, concentration risk becomes real damage. Imagine putting 40% of your portfolio into a single high-growth stock. That's $88,000. If that stock drops by 50%, which happens more often than people admit, you just lost $44,000. Nearly a quarter of your entire portfolio. Now, compare that to a properly diversified portfolio where no single position exceeds 10%. A similar downturn might cost you $26,000 instead. Still painful, but survivable. According to research from organizations like Morningstar, diversification reduces not just volatility, but the magnitude of catastrophic losses. It doesn't maximize returns. It protects the game. Think of it like building a house. At small scale, you can get away with cutting corners. But once the structure gets bigger, the foundation has to be stronger, or everything collapses under its own weight. Daniel and Priya, a dual-income couple, hit $215,000 invested early on. They concentrated heavily in technology stocks because it worked. Until it didn't. A downturn wipes out $35,000 in months. That moment forces a shift. They spread their investments across broader index funds, international exposure, and different asset classes. Their growth becomes steadier, less exciting, but far more durable. And this is where most people resist. Because diversification feels like slowing down. It feels like giving up upside. But at this level, your goal is no longer to win big. It is to avoid losing big. If you're getting value from this so far, this is the point where most people quietly realize they have been playing the wrong game. So take a second to like the video, not for me, but as a signal to yourself that you are ready to think differently about money. The action here is clear. Audit your portfolio. If one position can materially damage your future, it's too big. Because at $200,000, diversification is no longer a strategy. It's infrastructure. The fourth shift is quiet, almost invisible, and that's exactly why most people miss it. At smaller portfolio sizes, taxes feel like background noise. You pay a little here, lose a little there, and move on. But at $200,000, inefficiency becomes expensive. Let's say your portfolio generates $15,000 in gains in a year. Depending on how those gains are taxed short-term versus long-term, you could lose anywhere from $3,000 to $7,000 to taxes. Same investments, same returns. Different outcome. That difference compounds. Over 20 years, that gap alone can mean the difference between retiring with $600,000 or $800,000. Not because you invested better, because you kept more of what you earned. Research from firms like Vanguard consistently shows that tax-efficient strategies, things like asset location, tax loss harvesting, and holding periods can add up to 2% annually in after-tax returns. 2% sounds small, until you apply it to $200,000. That's $4,000 per year, every year. Think of taxes like a slow leak in a bucket. At low levels, you barely notice it. But as the bucket gets bigger, the leak drains real volume. Consider Tunde, a 42-year-old consultant. He actively trades within his brokerage account, chasing short-term gains. On paper, he performs well. But after taxes, his returns shrink significantly. Once he crosses $200,000, he changes approach. He shifts long-term holdings into tax-advantaged accounts where possible, reduces unnecessary trading, and becomes intentional about when he realizes gains. Nothing about his strategy becomes more complex, just more deliberate. The action here is direct. Start thinking in after-tax returns, not just returns. Because at this level, what you keep matters more than what you make. The fifth shift is the one that separates investors who build wealth from those who accidentally destroy it. Early on, risk feels exciting. You ask, how fast can this grow? You chase upside. You tolerate volatility. You experiment. And that works when your portfolio is small enough to recover from mistakes. But at $200,000, the question changes. Now it becomes, how do I grow without being forced to sell at the worst possible time? Because risk is no longer about percentages. It's about scenarios. Imagine your portfolio drops by 30%. At $250,000, that's a $75,000 decline. Now, layer in real life. Job loss, medical expense, family obligation. Suddenly, you're not just watching a decline. You're forced to sell into it. That's how wealth gets destroyed. Not by bad investments. By bad timing under pressure. According to research from J.P. Morgan Asset Management, missing just the 10 best days in the market over a 20-year period can cut your returns nearly in half. And those best days often come right after the worst ones. Which means if you exit during fear, you miss the recovery. Think of your portfolio like a bridge. Early on, you can take risks with the structure because there isn't much weight on it. But as it grows, the structure has to support more. One weak point, and the entire system fails under pressure. Take Ibrahim, who builds his portfolio to $260,000. He invests aggressively, fully exposed to equities, with no liquidity buffer. When an unexpected expense hits during a downturn, he has no choice but to sell investments at a loss. Years of compounding interrupted. Not because his strategy was wrong, because it wasn't resilient. The shift here is profound. You stop optimizing for maximum growth. You start optimizing for staying invested. That means building a cash buffer, aligning your portfolio with your time horizon, reducing the chance that life forces your hand at the wrong moment. Because at this level, the goal is no longer just to grow wealth. It's to protect your ability to let it grow. Now, here's how to apply all of this, depending on where you are right now. If you are below $100,000, your focus is still simple. You are the engine. Your job this week is to increase your contribution rate even slightly. Automate one additional transfer, even if it's just $100. At this stage, behavior matters more than optimization. If you are approaching $200,000 somewhere between $150,000 and $190,000, you are at the edge of the shift. Your job this week is to audit your structure. Look at your allocation. Look at your tax exposure. Look at your risk concentration. You are not trying to maximize returns anymore. You are preparing for scale. And if you are already above $200,000, your role has changed whether you realize it or not. Your job this week is to build resilience into your system. That means defining your rules for downturns, ensuring you have liquidity outside your investments, and reducing any single point of failure in your portfolio. At each stage, the question is different. Below the threshold, it's how do I build? Near the threshold, it's how do I prepare? Above it, it's how do I protect what's already working? Marcus is still sitting at that kitchen table, contributing $6,000 a year, measuring progress by what he adds. Elena looks at the same statement, but sees something different. Her contributions matter less now. Her system matters more. The gap between them was never about who worked harder. It was about who crossed the line where money starts behaving differently and adjusted accordingly. Because $200,000 is not just a number. It's a turning point. The moment a savings habit with ambition becomes a wealth engine with momentum. And if you understand that shift early, you don't just grow your money. You stop getting in its way. I'll see you in the next one.